And one of the things that I learned was, dealing with business owners, there were some challenges there because they don't fit neatly into a box. And, they know this when they try to go get loans. They know this when they try to do their taxes. On one hand, they have to try to look like they're not making a lot of money. On the other hand, they have to try to look like they're making a lot of money. Um, they don't fit neatly into an investment, risk profile, if you will, because by nature they're more risk takers and entrepreneurs. So, my skill set and background being in different investment lanes, started in oil and gas, back in oil and gas. So the alternative space has been fascinating for me, and it really is very appealing for entrepreneurial types. For the tax benefits and for the opportunity for returns. So just happy to be part of this conversation here with Lorraine, who obviously as you guys will see, has a lot of experience with the business owner landscape.
Thanks, Joe. Well, what our company specializes in is helping companies grow to the next level. And that might be for all kinds of reasons, so that the owner can get a better return, so that there's more predictable dividends, so that you can hire people to take over running your business on your behalf. But we also do this so that companies can get ready for acquisitions and become saleable. And we term the idea of saleable, meaning that it's an attractive to an ideal buyer. Because buyers, as you are going to find out in this presentation, are looking for something very specific. So you can do exit planning, you can do succession planning, you can look at your tax situation, you can accumulate wealth, but it doesn't mean that you can necessarily sell your business. And we will unpack what we mean by that. Now, I imagine you'll probably have questions as we go through this, and we'd love you to add your questions as you think of them in the Q&A. And then when we're finished the presentation, Joe and I will take questions and really dig deeper into anything that you want to talk about. So with that, we're going to turn on our first poll question. And of course, do I see where I can have it? Open poll, polls, quizzes. Sorry, a bit new at this. Poll question number 1. Who is in the audience? Tell us a little bit about yourself, and I'll just launch that. So are you a business owner? Do you have business partners? Because that affects the end game of why you're in business together. Does your business have investors? Are you a CPA or an advisor to business owners? So you can check all that are valid about you. A couple more minutes. And we'll end the poll. And we have business owners and we have people with business partners. So that's important. Business partners may have different views about what the value and the return on investment they're looking for from the business. So let's move on. That's very interesting. And we'll move that off my page. So, sorry, I'm just trying to move something off my page. There we go. You need to think about this in a different way for this presentation, because really you are the #1 investor in your business. You might not have outside investors, but you should see yourself as an investor in your business, because the more you can see your company as something that's an asset that you should get a return on investment on, the more easily you see the changes you want to make so that it gets you that return. So we're going to ask you to wear your investor hat for this presentation rather than your business owner hat, and examine what's missing from the returns you receive. And we always look at return on investment as more than just a financial return, because why you have a business, what's driving your business, and what drives your motivation is personal. Sometimes it's really tangible. You want more money. Sometimes, you're motivated to solve a problem and make a difference with how you provide your offering in the world. Sometimes it's validation. Some days you want more validation than you're getting. Are you being appreciated and acknowledged? Do your employees respond to your leadership? And sometimes what you're really looking for, but maybe haven't quite said it to yourself, is you're looking for peace of mind. You want financial certainty. You want certainty that the future you're aiming for is going to be envisioned and be realized. And of course, we know in life there are no guarantees, and we don't have all the control we wish we had over our future, but you can make it a lot more certain by taking the right steps in the right order, which is what we're going to talk about today. So, going back to what do we mean by wealth accumulation and what do we mean by return on investment? So, we buy assets, we might buy a stock, we might buy a house or a commercial property. And why do we buy these assets? Why do we try and develop them? Well, we want a return of some sort, and we think of a return when we invest in something. But when do we actually get that return? And this is a kind of a trick question, because it's not when we buy the asset or start the asset or develop the asset, it's when we sell it. Because when we go buy the stock, the money leaves our account and it sits, in somebody else's account, and the stock either goes up or it goes down. And at some point in time, and when is that point of time, you decide to sell it. Well, if you've set a goal that you want 100% return on that investment, and when you bought it 100 and you sell it 200, you realized your return on your investment. But a lot of people don't set goals for their investments. So you might fly past 200 and it might start dropping down after that. And if you set no goal or set no intention about it, you're now buffeted by a sense of risk. Oh my goodness. I counted on it going to 200, but it didn't. I did this when I first bought Apple stock, and I bought it at $100, strangely enough, and it moved to 200, but I never set a goal for it. And then it moved to 300, and then it moved to 400. I was like, I'm smart. I made a really good investment. And then sometime around 2012, there was an announcement from Apple, some negative news. And you may remember back in what that negative news was. I think it was 2011, 2012. Steve Jobs has pancreatic cancer. Oh my goodness. I never set a goal to sell. And so I watched Apple stock drop. But I had become attached to the number it actually got to, is about 700. And I couldn't let go. I had already made my money, even if I sold at 600, but because I'd become attached at 700, I wasn't about to say, oh, let's just sell. And this is the human psychology of when we choose to sell something is very complicated. We had this concept is called loss aversion, where we become attached to a number and then we can't move or make a good decision for ourselves if that number has changed. And this happens all the time in the sale of businesses, or the process that making a business saleable, or the process of going to a broker or an investment advisor to sell it. You think your business is worth X, and maybe your financial advisor has put a specific number in your net worth calculation, and you're now attached to that number. Well, does that mean that number is what your business is worth? Well, psychologically, it does to you and becomes very emotional, but that doesn't mean that it's actually going to sell for that, or that's what the business is worth. And so if by thinking about your company and weighing whether it should become an asset, or it's just, a great place to earn a salary and get some dividends, those are the things on the table for you. And it's really crucial to think about what that means for you. So let's look at poll question number 2. Just going to the poll. What are your expectations for your business? Beyond salary and dividends, I hope you're getting both salary and dividends. Are you counting on a bigger return from your investment in your business? Do you want to put it into your net worth calculation? So it's either yes or it's no, or maybe you're uncertain. Maybe you'd like to count on it, but you're not sure that's going to be possible. A couple more minutes while everybody finishes the poll. Well, I'm glad to say that you want more from your business. I imagine that's why you're here. So it's really crucial to recognize that as you listen to the rest of this presentation. If you want to make sure that your business gives you that return, you have to look at it with fresh eyes. So the question on the table is, should your business become a saleable asset? And that means you have to know the difference between owning a successful business makes you lots of money and owning a saleable business. And the two are not synonymous. And let me show you why they're not synonymous. So what we're looking at here is a presentation about the number of businesses that actually sell. And so of companies that have between 10 and 100 employees, so small to middle-sized companies, there are 3.3 million in the US. 54% of those companies, by the way, are owned by people over 50. And I always find that striking. I guess we're a lot more entrepreneurial and we open businesses later in life. But of those 54%, how many are saying they're going to sell within the next 5 years? Well, roughly 56%. Now, I look at that, I look at these numbers every year. I track this information since 2008. And I also track how much money is out there looking to make acquisitions. And back when I started this tracking in 2008, there was nowhere near 5 trillion looking for acquisitions. And it just, there wasn't the interest in buying private businesses. But now there's way more money looking for private businesses. So we're going to do a poll before I reveal how many you think actually get their deal done. So let's bring up this poll. Why won't you let me launch? It's not letting me launch. Okay, well, I'm going to stop the poll because it's being difficult. And let's just answer that question this way. Here is the number of mergers and acquisitions since 1985 for all types of businesses, all the way up to the first quarter of 2024. And you see the mid-range, the highest range it got to is 24,000. That was during COVID and also during a time when the tax code was changing in the US. So a lot of owners decided that was the year they had to sell. But on average, you see the numbers more like about 16,000, 18,000 per year, even though 997,920 say that each in the next 5 years, they're going to sell. Even if we divided that by 5, there's nowhere near the number of people exiting as those who say they're going to exit. So the actual answer is between 1% and 4% actually sell their business, even though they've set their intention. Even though I set my intention that I was going to sell Apple stock at 200, it was hard to do it. And setting the goal, setting the intention is only part of the process. So now you have to think about, is this a buyer's or seller's market? I am just going to bring up another poll. And my polls are not working. Too bad. Why not? There's more I have to learn about running the Zoom. I'm so apologize about that. So when we look at this and we see that 5 trillion is looking for acquisitions, but only 18,000 companies are selling, what do you think, Joe? Is it a buyer's or seller's market? We'll ask you.
So that's a very divergence in the data there. It's crazy. I could say just one thing I'll add too is, a lot of people assume that they can list with a business broker and that their business will sell. I got nothing against business brokers. I know a lot of great ones. But the reality is, I think only about 20% of businesses listed with a business broker. These are businesses that are actually actively marketed and listed. Only about 20% of them actually sell. So it just goes to show you there's definitely not a reliability in just listing the business and trusting that it's going to sell for what you want it to sell for. But there are people looking for businesses.
Yes, I'm asked all the time, looking for very specific businesses, how can I find them? And I think the answer to this is that it's a buyer's market. It's always been a buyer's market. And even though it's a big source of supply, it'll never be a seller's market for your business. And that's a crucial thing to realize in advance of thinking that you have enough in your nest egg for your retirement, which is why we're having this webinar. It is a buyer's market, and it's specifically because even though there's great successful companies out there, and that there's 5 billion trillion searching, the majority of buyers are super picky. They are acquiring companies that solve their growth problem. And that means you have to fit into a niche that they're looking for to solve that problem. Otherwise, they're not interested in buying. And that is reflected in the backdrop of who buys businesses. So super important to understand that other companies buy 85%, roughly the same number year after year after year. So of those 18,000 companies that sell in an average year, 85% are being bought by other companies, and they're looking for the thing that's going to solve their growth problem, get them into a new market, add a component or an element that broadens their offering that their customers are looking at, adds key people with expertise that they don't have, or grows a whole other division or something else they can add on in their vertical market or their horizontal market, vertical, to get them where they want to go. And if your company can become that thing that they're looking for, that's what we mean by saleable. Private equity buys the rest of the majority. Private equity are groups of people that have amassed a fund, and they are looking for specific companies that fit the parameters of the fund. So they have to get a big return on investment because all these people invested in them to find these companies that drive growth. So they're looking for 30% year-over-year growth. 8% of buyers are looking for a majority stake or the entire business, and they're not interested in less than that. So either they're in control or they're not interested. And I say not operators. Those are people that are investment bankers by profession rather than business operators. There's also a smaller subset of private equity that has owned businesses before, and they understand the business owner situation. They are perhaps more compassionate, but they also have to fulfill the mandates of the people that have funded and invested in them. But they're probably going to give you a longer runway to achieve that 30% or more year-over-year growth. And then there are very few private equity groups, 2%, that invest as a minority partner. And then what you have left are management buyout to a family member or to another employee. But remember that those people are not entrepreneurs. They've had a nice steady paycheck for a long time, and to suddenly step out of that and into a risk position where they're having to weigh decisions that you have to weigh every day is not an easy transition. Yes, there's money to back those people buying your business, but it happens over 5, 6, 7 years, and you're waiting to be paid over that time period, which again changes the equation on your return on investment. So what kinds of businesses are they buying? This is data over the last 30 years. So, is your business in this area, healthcare, consumer staples? Industrials is everything to do with manufacturing, professional services. And you can see that there's just the biggest sector is still high tech. In the tech world, those are the high growth businesses with the big gross margins. So what does this mean for you? Well, you have to understand the buyer mentality, which is why it's so important to wear the investor hat if you really want a return on investment. And return on investment has to become your top priority, because the buyer is the one that sets the price. And if you become attached to what you think your business is worth today, it becomes very difficult to let go of the business when it comes time to sell. And in fact, we just got a new client. He has 3 offers for his business, and he can't sign on the dotted line. He has to sit back and go, how's this going to affect my family, my father? He's going to probably lose the sale of his business because he didn't go through this kind of thinking and weighing of the deeply personal and legacy issues that make selling a business super important. So what we talk to our owners about, our clients, is you have to acknowledge all that you've done to build your business, because you are valuing the past. The buyer is valuing the future that they may be able to achieve with your business, and that's what they're acquiring: the solution to the problem, the growth path, and that there is going to be more value in the future that they're going to bring. And when you recognize that that's what they're buying and you are selling that opportunity for them, they will set the price and you move with that price, because finding another buyer that's as interested as the one you have on the table is very difficult. So watch the tendency to become attached to what you think your business is worth, because then you activate that loss aversion problem, and stop making any meaning about what your company's worth. It means nothing. Beauty is in the eye of the beholder. And in this case, selling a business means the buyer chooses the number. Be grateful. It's a good deal if you like the deal, or say no and realize that you might be on a different path to getting a return on investment. Now you're looking at perhaps closing one day, so you need to put aside your dividends and your salary. So what are buyers' top red flags? Well, they're looking at, is the strategic plan, and we're looking at red flags, is it going to solve their problem? And they can spot in an instance. They know exactly what they're looking for. And if it doesn't fit into their buyer platform, they're not even talking to you. They're just saying no. So they need a management team that doesn't include the owner that's selling and leaving. There's a trend. The trends reveal that demand is inconsistent. Demand for your products, demand for your offering. They don't like that. They want an uptick in trends and growth. Scale up problems. Every business has scale up problems. And when you try and get past that 5 million mark, that's when you have to start putting in structure and a management team around you, and you have to become attuned to the sound of complaints when the organization is grinding through its development of systems, and you got to pay attention and solve those problems. So these are some of the things that cause buyers to pause and go, that's probably not a fit for us. But these are also the elements, the red flag elements that make growth difficult and make growing difficult and make predictable dividends difficult, make it hard to have cash available to grow. And so these are all the things that we help a business with to grow to the next level. So, when you want to talk about this, these are the areas we drill down on, because we know these are the things, when you solve these problems, growth happens. So, all of this helps you, when you think about it, give you the peace of mind about your future. And if you want more certainty about your future, then you have to examine where you're heading today to see if you can deliver on these expectations. So let's see if I can get this poll question done. So thinking about where your comfort zone is. Just a minute. I'm still not getting what I want. Expectations. Okay. So which plan is more uncomfortable for you? Doing what you've always done while hoping for your desired outcome, or implementing new ideas and strategies you might not yet be familiar with to plan for your desired outcome? And most of us, it can be difficult to take on something new and trust that it's going to give you the certainty you want. But then you also have to contrast that with your current path you're on. How much certainty do you have today that where you're going is where you want to get to? And it's that sometimes, as we have our heads down and busy getting the day to day, the future is missing in our planning. So doing what you've always done while hoping for a desired outcome. Yeah, good. Okay. So interesting to think about that. And of course, that's what we're all about here. We're questioning our assumptions. So, and then we bring in the question about risk versus return on investment, because risk hits us when everybody has a different risk tolerance for different things that you can deal with. So can you flex? Can you adapt? Can you keep moving forward despite rocky seas? Well, everybody that's an entrepreneur probably can in the day-to-day running of the business, but maybe there's some things like how you're going to manage people, or one of your key people you rely on suddenly decides to move on, and now all of a sudden your business feels risky, and hiring someone else feels risky, and filling that role feels risky. So we have some tolerance or more tolerance for some things than others, but we often don't understand how much risk we're actually willing to take when we think about our business as an asset. What if this business just can't sell, and what if it closes one day? Does your heart catch and your stomach grind into a knot? That fear of not getting the outcome that you wanted, that's hard. And now you're starting to feel like that's too risky to go on hoping for that, but not sure if you're on the path for it. So, when Joe and I put this presentation together, we talked about how inaction actually creates more risk with less return on investment. Most of us, don't want to deal with these bigger questions, so we keep going, and then one day we end up having to close the doors. And that's happening across North America, the US. Companies are closing, and there is no further return on investment. There's hopefully you put aside the salary, hopefully you invested the dividends in other assets other than your business. But if you really want more from your business, you have to pay attention, and you have to set intentions, and you have to follow them and keep reviewing your intentions and your actions to get your desired end result. So thinking about that, what is intention and action? Well, I think we're going to go to Joe next. Where are we? Where are you, Joe? And I'm going to come back to that.
Yeah,
So
so
go ahead.
yeah, thanks, Lorraine. So, when I was an advisor and dealing with a lot of business owners, they would come into my office or meet with us, and obviously the conversation around assets and lifestyle comes up, and 8 out of 10 conversations with new people, you're hearing, well, I have a 401k, I have my IRAs, I have my health savings account, I got this and I got that, and I got my W-2 job, and I plan on taking Social Security at 66 and a half. And then you get with a business owner and they say, oh, I don't know, I got some mutual funds over here, I bought something from a guy over there, but really everything I got is in my business. And that's how I make all this money. That's how I've done, better than average. It's my baby. But literally everything's in there. All my cash, my investments are in there. So what I found was, talking to business owners about, the broad stock market, their eyes would kind of glaze over. They're business owners for a reason. They're entrepreneur. They like hands-on. They like tangible assets and things like that. So, how do you move from creating this business that paid you well to now I have to think about when I'm out of this business, if I am out of this business, can it still pay me? How am I paying my lifestyle needs? How am I paying my family, et cetera? So you can go ahead, Lorraine. So the answer is alternatives. And alternatives kind of has a weird connotation. People think alternative kind of they might associate with maybe alternative medicine, or you don't agree with that, or alternative sources of extras, whatever. And you don't think you don't like that. Alternative does not have a negative word as it relates to investments. Alternative is other options. And, so we're going to talk a little bit about here. I'll make it kind of quick for the sake of time. What are they? What's the benefit of alternative investment? What are the risks involved? Because there are risks like any other investment. And then most importantly, giving you guys a couple of takeaways on how do you assess one of these investments. So go ahead. When we talk about alternatives, what do I mean by that? I really mean, essentially the private markets. So if you look at the top companies in the United States, companies with $100 million in revenue and up, 87% of those companies are private. That's a tremendous amount of money. So the challenge is a lot of people don't know that. The majority of wealth in this country, the majority of opportunity in this country is small business, is the Main Street businesses, is private investment. But mainstream media is not going to tell you to go invest in a self-storage facility, right? Like the financial gurus online are not going to tell you that. So you got to kind of either have an advisor, a CPA, be curious yourself, kind of like I was and in the industry to learn about all these types of investments. So go ahead. Next slide. So just a couple of sub asset classes of alternative investments just to help you paint the picture in your mind a little more clear. We're talking private equity. Lorraine mentioned that and the important role that private equity has as it relates to buying and selling businesses, hedge funds, real assets, real estate. So, that could be, multifamily unit, commercial real estate, medical space, self-storage, private debt. Venture capital is a popular one. Everyone has the venture capital stories and sees the venture capitalists who have done really well. Tangible assets, that could be things like collectibles. This is where you're getting into commodities, hard tangible assets, and then structured products. Structured products is a term a lot of people aren't familiar with, and that sort of has a confusing sort of feature about it because part of structured products is dealing in the public markets, but it's creating derivative investments off of publicly traded securities. Any one of these categories can cross over into another. For example, I'm in the oil and gas industry. You can consider that a tangible asset, but that's also real estate. We deal with land, we deal with mineral rights, we deal with deeds recorded at the county. So location plays a part. So it's just different ways to invest, and then sub classes of those is exponential, as you can imagine. So why should you be interested in alternatives? First of all, I'll say this: everybody should be interested in alternatives. Everybody. If you're a person that has 100% of your money in the broad stock market, you're not diversified. So number one, portfolio diversification. And what I mean by diversification is really two non-correlating asset classes or more. If you're in stocks and bonds, a 60-40 portfolio, you're all in the publicly traded market. And we know how the markets can move without, any hand of your own and, without any, foresight to seeing that happen. So you have to diversify tangible assets, intangible assets, publicly traded, privately traded, real estate, business ownership, et cetera. Tax strategy. It's the smallest lettering on there, but that was just for the the formatting. But it's one of the most important when you're looking for keeping more money in your pocket, paying less to the IRS. Number one conversation I would have with business owners. I mean, right off the bat, what do you want to accomplish? Number one, hands down, I want to pay less taxes. I make great money and I can't figure out how to pay less taxes. And my CPA just tells me to go buy another truck and I don't need another truck. So nothing against CPAs. If anybody watching is a CPA, there's a couple different kinds of CPAs. A lot of CPAs are bringing different deals to the tables nowadays. So it's really good for business owners, but huge opportunity to save money, to keep money in your pocket. This is money you don't have to pay legally if you know the right investments to get into. The variety of investment opportunities. You can stay on that slide for just another minute, Lorraine.
Sorry, pardon me.
No worries. Yep. Variety of investment opportunities. So I've just riddled off, 6 or 7, but there are hundreds of different types of opportunities that you can invest in. If you want to own pieces of, the restaurant industry, pieces of the fitness industry. I talked to a person the other day that ran a wild exotic animal alternative investment. That's one I never heard of. I couldn't explain it to you. I have no idea how it works, but there it is. There's tax benefits. There's something involved in it. Low or no correlation to the broad stock market. This is a huge one. This is why I say, even when I was an advisor, 10 to 20% of your assets should be in alternatives. If you have the capital, if you're accredited and you can do it, they should be in alternatives because you're not correlated traditionally to the stock market. You're often insulated. And then, this is one that people have a kind of a weird hesitancy to talk about, but let's just call it what it is. You want to make money. That's why you invest. Otherwise, you would bury it in the yard or put it in your walls like my
Mhm.
grandparents did, right? You want your money to make money. Superior long-term return on investment. You're not satisfied with the status quo average. You're not satisfied with the bank rate CD. You want superior returns. Those are all the reasons that you would look at alternatives. So go ahead, next slide, Lorraine, thanks. Here's a couple of trends here that's important to know. When I started in financial services close to 20 years ago, alternatives, I don't even think I knew what it was, and most people I was around didn't really know what it was. Now we got more than half of the advisors are incorporating alternative investments into their client portfolios. The advisors are looking for something new. They're looking for a something to bring to the table that's different. Because if you're an advisor amongst the sea of advisors and all you're doing is model portfolios and modern portfolio theory in the stock market, well, it's very hard to differentiate yourself and offer something different to the public. You got to bring some different ideas, different things to the table. Also, with the rise in tax rates, with people making more money, dealing more with taxes now, people are looking for solutions and alternatives are coming to the table. So huge trends in alternative assets, 8 trillion over the next 5 years. So the numbers speak for themselves. So a couple of things here, criteria to use when analyzing any alternative investment. These might seem simple on the surface, but they're super important. Number one, managing partner experience. So when you, to Lorraine's example, when you buy shares of Apple, right, I'm going back to the stock market when I was a day traded for a while too, so I'm a little tainted on how the market works. But most people, they do fundamental analysis. They like the company, they like the financials, they like the CEO, they buy the stock. I did technical analysis, so I paid no attention to any of that. I used charts and indicators and data. But with alternative assets, it's even more important that you look at the managing partner experience. And I'll give you an example. So I'm in the oil and gas industry. There's a lot of people that get into the oil and gas industry and start a fund, start raising capital, start trying to deploy capital, but their background and skill set was in commercial real estate. And they think it's close enough that there's a huge opportunity in oil and gas. Let's go raise money for oil and gas. Well, I could tell you, just the same way as if we're in oil and gas and we wanted to go do the wild exotic animal farm, you probably don't want to invest with us if that's what we're doing. You want to know that your operator has experience. The same way, think of your business. You have experience in your business. I would invest with you based on your experience in your business. That's very important. The other thing is fee structure. Um, I'm not going to, we don't even need to poll. We could have done a poll here. How many people read their memorandums on their or the prospectus of their mutual funds or the insurance contract? Okay, Lorraine, well, there's always one out of 100, right? We'll read them. Even the ones that read them, how many really understand them? So the thing is, you have to do a little extra work with alternatives. The onus is on you, or as an advisor, you're going to have to do a little extra work. There's a little more involved than just picking an ETF or a mutual fund or balancing a portfolio, right? In the publicly traded markets. You got to go through these memorandums and you have to understand what you're actually paying because the fees can be all over the place depending on the type of asset, the operator, the company, the deal structure, things like that. But if you're going into business with somebody, just like as if you're going into business with your friend and you're both putting up money, you're going to want to know what your money's going to do for you. So fees are super important. Number three would be the alignment of risk and interest. Okay, so what do I mean by that? I mean, simple question you can ask. As I'm reading through this memorandum, as I'm looking at this deal, are there situations or scenarios where the sponsor, the operator, general partner, where they win and I lose? There's deals out there like that. There's deals out there where the operator makes a ton of money just for raising capital. Then you have to ask yourself, what's their incentive to then go manage good assets if they've already, their profit center is already achieved on the front end? You want to know this, right? If you and I were going into business together, often doing a coffee shop, and I said, "Hey, I know coffee, and I need $500,000 to open this shop, and I'm going to take a fee, an upfront fee of 20%, right? And that's going to cover me, and the profit is yours." Well, I already made my money by you investing with me, right? What incentive do I actually have to go and run the world's best coffee shop? You have to look at these things and think the same way you've been thinking as a business owner. And if you're an advisor and a CPA, the same way you've been advising your client to think as a business owner. All right. And then number four is the risk return, as the potential return profile. Again, you're not looking at alternatives for uh, CD bank rate security. That's not what you're doing. It's a different animal. You're looking at alternatives because you want to make money. You want your money to have a potential larger return than any of your other money outside of your business. All right. And those are the things that you got to look at, and does that risk return profile match the capital you have, your stomach for risk, and your timeline? So when looking at alternatives, now I'll kind of pivot and talk specifically about the space that I know the best, which is direct energy, oil and gas. So why do people invest in oil and gas? Why should you consider it? Number one, to retain and grow your wealth. I mean, that's number one. The first big key benefit is paying less taxes. I'm going to touch on this in a second, and I have a tax benefits guide that I can send anybody that's interested. But when I was an advisor and someone would make the comment, "I want to pay less taxes," I usually respond with a question, sort of in jest, but just to have fun with the conversation. Okay, how complicated do you want your life to be? And that'll determine how little in taxes you can actually pay legally, right? Because there's this spectrum of complexity and simplicity. Something that's simple doesn't really get you a whole lot of, you can give a little bit of extra charitable giving, right? But something that's very complex, right? Maybe, family limited partnership structures with LLCs, and the kids have trusts inside the LLCs, that all of that, right? That's complicated, costs tens of thousands of dollars to do, but you can have phenomenal tax benefits associated with it. The cool thing about oil and gas, it's on the side of simple, but it has the benefit of being of as if it was complex. Very tremendous, heavy tax benefits associated with oil and gas. We'll touch on those specifically before we end. Own physical assets. You're owning working interests in oil and gas wells and producing oil and gas wells. And what I mean by that is these are deeds recorded at the county. This is ownership. Even outside of, if Invito took a company vacation and the bus went off the cliff, you still own these working interests, tangible assets, physical assets. Lower portfolio volatility. I mean, again, traditionally non-correlated to the broad stock market. So, that's true diversification, is getting outside of that one sandbox, the stock market, and starting to build a moat around it of other types of investments. And then to create passive income. Our particular fund pays dividends on our distributions quarterly. And, we like to call it mailbox money. So it's, similar to what people are used to in the real estate world. You can go to the next one and we'll touch on some of the tax benefits. So I'm going to cruise through these pretty quick here. three pillars of the tax benefit. Number one, the IRS lets you write off the intangible drilling costs in the year that you make the investment. Intangible drilling costs on a gas and oil investment typically range from 75 to 85% of your dollars. So simple math, you put $100,000 in, you write off $80,000 off of ordinary income. That's a key. You see tax codes referenced there. I have it again. I have a tax benefits guide. I'm happy to share with anybody who wants it. Just get in touch with me, and I'll be happy to share that with you. It also references the K-1s and the flow through into the 1040 as well. So huge tax deduction benefit. We have people who are doing Roth conversions right now, and they're using oil and gas to offset that Roth conversion tax. But any ordinary income you have, this is a direct offset to it and a tremendous one. So as far as investments go, I don't know any other investment that gives you a bigger bang for your buck as far as a simple deduction with zero audit risk. These tax codes have been in play for decades. I think before I was born, actually, and I'm not young anymore. So we also have tangible drilling costs. All right. So similar to real estate, you get to depreciate these things. This is another 15%, 20, 25% of your invested dollars get depreciated over another 5 years. In place now, we have accelerated depreciation. So this year we can accelerate 60% of that. So you're getting to depreciate that as well. And then on the income side of things, something called small producers depletion allowance basically says that all income, 15% of the income right off the top, every time you get a dollar, 15 cents is going to be tax-free for as long as you're getting revenue from those wells. So three tremendous tax benefits with zero audit risk. And by the way, if you're a CPA or you're an investor that has a CPA, this is partnership accounting. CPAs know this. It's one of the first things they learn. So there's no complexity to this in any way, shape, or form, which is pretty cool. So we'll go on to a quick example here, just to put some real numbers to it. Take a person with a $500,000 taxable income. On the left side, they made no investment. On the right side, they made an investment. They made an investment of $200,000. They dropped their AGI now to 340 because the intangible drilling costs were 80%. 80% of 200 is 160,000. So they reduced their taxable income from 500,000 to now 340, and their tax bill saved them $59,000 by making the investment. A couple different ways to look at that. One is that could be immediate return on your dollars that exists in this investment. The other would be just that you have net out of pocket. So for example, you invested 200,000, but you kept 60,000. You have net out of pocket $140,000 for a $200,000 investment. So you already had equity in the deal, which is pretty cool. And oil and gas does that for you. Moving on. So we have a current offering out right now. Everybody wants to know the numbers because, again, it's about, return on investment. I could get more into this at another time with you off to the side, but just to give you an idea, we underwrite our deals using $60 oil. We have to pick an oil price. That's the variable, right? So we want to make sure that any projects we put into our fund are profitable at 60, which is very conservative if you're paying attention to oil. It's been in the high 70s to mid 80s for a while now. Which is phenomenal. But, at an $80 range, we're looking at it, 2 to 2.5 times the original investment over a 5-year period. We look at in oil and gas, we talk primarily about total return and internal rate of return because we want to focus on the time value of money. It's different than real estate, because the time value of money plays a factor because everything happens early in oil and gas. So I'm going to leave you guys with this quick sort of elementary example, if you will. If you took a 5-year real estate investment and you took a 5-year oil and gas investment, and the numbers don't matter. Let's just say you started with the same number and you ended with the same number as far as dollars in, dollars out, wrapped all the benefits together. Okay. in real estate, what you're used to is your cap rate, your rent roll. Years 1, 2, 3, 4, 5. I'm getting my 7%, 8%, whatever the current cap rate is in your project, right? I'm getting that rent. That's kind of my steady Eddie dividend. It's predictable, it's reliable. I know there's some vacancies and some issues, but I know what I'm getting, and I know when I'm getting it every month. The big thing happens at the end of that period of time, maybe 5 years out, and you have a liquidity event where you refinance the property, take some cash out, or you sell the property because it's appreciated in value, and now you put a bunch of money in your pocket all in one shot. So steady Eddie, big bang at the end. Real estate's kind of the opposite. You're getting all of that, but you're getting it along the way, and you're getting it early. So year one's going to be liquidity and cash flow starting. So you're getting immediate tax dollars that were headed en route to the IRS. They're back in your account. All right. You're getting cash flow starting. We call that X. The next year is cash flow X plus. These are wells, pressure, production. So this isn't rent. And then, the next couple of years is X plus plus. These are when wells are at peak capacity and peak production, and they're just raging. And then in years 5 and beyond, they start to taper off pretty quick. The end result is that you got your liquidity, you got your return, you got it closer to the beginning of the investment, as opposed to real estate, where you got the biggest move at the end of a certain amount of years. And so I'll say this, that I'm not an either or guy. I'm not hey, gas and oil is better than real estate. I've been involved in both. And I think there's a place for both. Ideally, again, diversification. If you can own some real estate and you can own some gas and oil, now you have different speed of cash flow, you have different tax benefits, and you own different tangible assets, and you're even better diversified. So if anybody has any interest in any of more detail on our current offering, whether it be the tax benefits, just understanding gas and oil, or some of the ways that we do oil and gas, I'm happy to have those conversations with you, and I have plenty of materials I can send you as well.
Thank you, Joe. So here we've planted some ideas in your mind about how to get the peace of mind about your financial future. And also, if you want something more immediate, like tax benefit, just paid your taxes or filed your return yesterday. And now you're thinking about, wow, what can I get out of my business, out of my financial situation this coming year? And it's super important to think that way, because the seeds you plant today are going to bloom hopefully later this year, but also in the future. I just wanted to suggest that one way that you can get peace of mind is to look at doing a decision roadmap. Do I want to turn my business into a saleable asset? And this is where we help you understand the value of your business today. And we help you understand your tax situation by talking to your financial advisor, by looking at how many dividends you throw off. We can work on figuring out how to get more predictable dividends, and honing your goals with your financial advisor, with your team, to make sure that you're operating at the level of risk tolerance that's good for you, but you're also aspiring to the goals and the desired end result that's important to you within the company's capabilities. And, working with people like Joe, with your financial advisor, that's something that we do all the time. We team up with your team so that you can weigh these decisions about your business and the value that you want to get out of it. And then we hone in on who that ideal buyer is, which is the crucial piece to becoming saleable. That's the third step. And in step 4, we figure out, okay, what changes do you need to make in your business so that you can solve the red flags that keep it less profitable, hard to grow, hard to manage, people issues getting in the way, and make it more like what your ideal buyer wants, on a path to growth, and easier to manage. And, one of those things in your transition plan might be taking on more alternative investments and working with Invito Energy to do that. And, we leave you with your plan, or we can help you implement that plan. So we're going to go to questions now in the Q&A. Just let us know what it is that you'd like to know more about. add your questions. But in the meantime, you can contact me for the decision roadmap, for figuring out how to get more predictable dividends, and contact Joe to explore oil and gas income tax advantages. But also, I think it's really important that you contact your financial advisor to find out whether your net worth and what they've been calculating includes your business. And really, get clear about what that valuation is today and what it could be, because we want to help you close that valuation gap, so you're not hanging on to a number that's never going to result in anything, and you're moving towards a valuation and a saleability event that actually gets you the return you really want. So, questions?
Thing I'll say too, while we're waiting to see if anybody throws any questions in the chat, the time to start looking at this is yesterday. If you own a business, I say that not to just be flip about it, but usually when people decide that they want to sell their business, it's already too late. They've not taken any action. They've not put the time in to build up. So now they're in their late 50s or 60s, and they're already counting down to the time that they can sort of step away. And then they get advice, they get counsel, they get, people around them saying, hey, you need to do X, Y, and Z in order for this business to be marketable. Because right now, it's only valuable to you. We need to make it valuable to the public so that there's a group of buyers that want it and can fight over it. But you have to start implementing these things. What happens is a lot of times that business owner becomes very uncomfortable because in their mind, they're already starting to wind down. But now somebody's coming along coaching them saying, well, no, you have to wind up. You have to start implementing scalability. You have to start thinking about your legacy. You have to start thinking about your identity when you're not this business owner anymore and you don't identify with that business directly. So I say the time is yesterday. If you think, I'm in my 30s and I want to sell my business when I'm 60, it's going to be a lot easier for you to start having conversations, start looking at implementing some of these things now than when you're, 59 and a half and you just retired and you want to sell your business next year. And so you'll list it with a business broker. These things can be very crucial steps. And, I know the type of work, that Lorraine does is really kind of walking people through these processes to make sure that they're digestible and that they get to the end result. And that's, what we all want to see. So we do have a question here. I'm trying to buy a business at the moment, but there are some major red flags, a lot of what you describe. How do I encourage the business owner to see, sense, and start listening to the things you are saying? I'd probably say send them the recording.
Yeah, send them a recording. We also often work with buyers, and the buyer will introduce us to the owner, because we talk about the things that they care about, and of course, it's hard for you wanting to acquire the business to ask the same kinds of questions without getting pushback from the owner. So one thing, Anthony, that you can think about is that if you want to buy the business the way it is, you can solve or work with someone like us to solve for the red flags so that you can turn it into a saleable business and then sell later. But there's a lot of owners out there that are never going to make the changes. They don't want to take the time to learn. So if it's not, if you're not making progress, make an offer. Just make sure it reflects what it's worth today. And that will be one lucky owner that gets a buyer like you.
Yeah, and one thing I would say too, obviously not knowing what business it is in any way, shape, or form, but find a similar business. And if the hurdle to the deal getting done is personal, I'm more on the personal side with maybe an owner who's a little bit headstrong and not kind of seeing the forest through the trees. Find a similar competitor business and approach them and just say, hey, I'm looking at buying, you don't have to name them, but a car wash just like yours. Would you ever be interested in selling? And you might find somebody. That's the other thing. A lot of times business owners are out there and they don't know that they could possibly sell their business. They haven't thought about it yet, or they're approaching that retirement age and no little birdie came whispering in their ear saying, I'm interested in what you have here. Would you ever sit down, have a cup of coffee, and let's just kind of chat through some things? You might find that a different personality is less of a hurdle. So just something to think about. But yeah, definitely, I would go with Lorraine's advice on that, and try to get that owner, this kind of information, or kind of go through it yourself as a future potential owner.
Any other questions? Okay. Well, thank you everybody for attending. We will be sending the replay out, and we'll also send out a link with Joe's calendar, and I'll send one for my calendar if you want to talk about further questions and explore your specific situation. And I wish you all the best in never encountering loss aversion and following your intention with the level of attention that it needs. Thanks so much for attending. Have a great day.
Bye.